This is the Doc and Eric Dubin with the SD Weekly Metals and Markets Wrap. Joining us again is our good friend Alasdair Macleod from the other side of the pond. It's great to have you back, Alasdair.
It's nice to be back. Thank you.
Well, we hope you enjoyed your vacation in Thailand, and we're glad to have you back at the markets, giving us some excellent analysis as always.
Well, I hope I'll do my best. Thanks.
Well, we've had quite some excitement this week. The FOMC released the statement on Wednesday, and for one of the few times in recent memory, gold and silver actually rose after the announcement. We're recording after the close here Thursday, and we saw a pop to the upside in both metals, silver spiking above 16 and actually continuing to rise here on Thursday, touched I think 1620 for a high, and really the same thing in gold. Gold spiked above 1150, actually neared 1175 overnight Asian London trading here on Thursday. And really gold and silver have consolidated and held on to their gains throughout the day here Thursday. We did see a flash crash after the close yesterday in the dollar, quite a big move for the global reserve currency. But the dollar actually has popped back up here today on Thursday and recovered most of its gains. What's your take on all of the craziness and the action in the markets here this week, Alasdair?
Well, in most major currencies, we've had 2 days of moves against the dollar of over 2%. I mean, first one way and then the other. I mean, this volatility is really quite unusual. And I think it's justified because effectively the FOMC threw in the towel about interest rates. All this stuff about patience and all the rest of it was just a smokescreen. But actually, what the FOMC said is we're not putting interest rates up for the foreseeable future. It was going to happen. It was logical anyway, because every industrial report, whether it's housing starts or industrial production or whatever, all these reports were indicating that the US economy actually is sinking. The only figure which is just absolutely wonderful and everything's fine are the unemployment numbers. And the unemployment numbers are absolutely crazy. I mean, in February, housing starts more or less collapsed because of the weather. What did the February figures say for employment in that sector? Up 17,200. I mean, it is beyond bizarre. So, but the problem is that the FOMC has to work. It's taken a rod to beat itself with, because it's saying that unemployment is one of the two metrics which it's really going to be looking at. It wanted to see unemployment down below 6% before it moved interest rates. We're now down at 5.5%, still hasn't moved interest rates. We know that figure is absolute rubbish, but the fact of the matter is that the US economy is stalling. The rest of the world has already stalled. You have got credit bubbles everywhere. I mean, the credit bubble in China is absolutely enormous. And these things are going into reverse. That, I think, is one of the things that's driven the dollar up. You've got people who have just been moving out of other currencies. Other currencies have been trying to duck the issue. They don't see any inflation in their statistics, so they think, well, if we can cut interest rates, even negative interest rates, then we will stimulate some sort of recovery. Fat chance. It's not happening. So I think the FOMC are boxed into a corner, and their minutes basically told the world that that is the case.
Now, Alasdair, going forward, so what's your take here on the dollar? Will the markets effectively call the Fed's bluff? Is the dollar's rise over, do you think, or do you think it'll continue to extend the parabolic rise we've seen over the last few months?
Well, there's lots of things like carry trades and all the rest of it probably still to unwind. I think there are lots of international corporations who have borrowed in dollars and finding they've got to cover the position. Now, how long that goes, honestly, we don't know. But underlying this, I think that the dollar basically is fundamentally weak. All these paper currencies are fundamentally weak. We're seeing the euro is going down the pan. The yen is going down the pan. And I think it's only a matter of time before people wake up. And that's the importance of these FOMC minutes. The Fed cannot now manage the situation. It cannot manage the currency. All it can do is undermine the currency. So on that basis, I think I'm a seller of the dollar. But what do you buy when you sell the dollar? to my mind, the only thing that you can really do, the safest thing to do, is to buy the cheapest asset there is around, and that is real money, and that's gold or silver.
And it's interesting to look at the whole currency shifts. I mean, when the dollar went over, 100 on the index, and then the euro was getting ready to test parity with the dollar, major economic forces were pinging the radar of the Federal Reserve and the ECB because of just the trade flows that are being switched around, with United States S&P 500 company earnings being somewhere around 65-70% sensitive to international trade, and the dollar rising so much, the entire underpinning for the earnings on the S&P 500 is being shaken to the core with the dollar's rise. And that had to have given a lot of concern to the Federal Reserve, economy rolling over as it is, and then the profits underpinning what is basically an overvalued stock market are coming under question as well too. So when I saw that huge move with the dollar falling yesterday, it told me that, oh, okay, well, I guess a bunch of hot money speculation is figuring that the policymakers are going to try to jockey a bit to cool the jets of the dollar versus the euro and the Japanese yen in particular, and try to forestall further, at least very rapid rises in the dollar. But what's so interesting is that today, as we record with Thursday, the dollar is right back up to where it was before the FOMC announcement. So we have a broken system, and the general trajectory of it is to remain broken and to continue to sputter out of control. I mean, that's really the bottom line that I think that the tale of the tape tells this week. So it's not a particular rosy scenario. And, I agree with Alasdair. I think that, from an insurance point of view, you absolutely must own precious metals. And from an investment point of view, I think there's a lot of upside to be had going forward, particularly in the miners.
I agree with Eric on that one. There is only one asset that actually hasn't moved on the back of these low interest rates, and that is gold. And there is so much that is ridiculous. The whole concept of negative interest rates is completely ridiculous. I mean, it is beyond ridiculous. And so when markets get to this sort of psychology, you know that there is a big reset coming. And I think out of that reset, bonds are probably the fundamental background to this, and that is a real problem, because good quality bonds are basically the lubrication for the shadow banking, the shadow banking market. And if you haven't got enough of those to go around, and if the prices of those start falling, you've then got problems developing in shadow banking. And, particularly in China, this is a huge, huge problem. So there are dangers all over the place, and there's a sort of feeling, I think, that something is about to break. We don't know what it is, but something is about to break. And I think the safest asset is the one thing that hasn't moved up on all this, and that's got to be precious metals. So really, you fly blind a bit on this, but I think anyone who hasn't got any precious metals, I think, is making a big, big mistake. And there are also big changes going on geopolitically, and if I can just move on to that topic, I don't know whether this has hit the headlines in America very much, but China and Russia have jointly set up a new infrastructure investment bank, which is going to be concentrating in Asia. And amazingly, Britain broke ranks as a NATO member and decided that they were going to become a founder member of this bank. The Americans were very upset about this, but then no sooner had we done that when we find that Australia says, we're thinking of going too, having already given assurances that they weren't going to become a founder member. And Germany and France and Italy are also joining as founder members. So you've got not only the whole of your Pacific allies leaving, if you like, the establishment, the World Bank and and similar organizations, and going into this new non-dollar supranational institution, but you've also got NATO members going. So where does that leave the Ukraine situation? I mean, because Russia is in this bank. It is one of the co-leaders of this bank. And I think what we're seeing is we're seeing a very, very clever move by the Chinese and the Russians, basically, to dismantle the alliances which are against Russia and China in the West. NATO is falling apart, and so the American Pacific Alliance is falling apart. Everybody's going to this new bank. And why? For the very simple reason that it's commerce. This bank is going to be the lead financing for infrastructure for half the world, and the half of the world that is developing very, very rapidly. We're talking about virtually the whole of Asia. I mean, by the time India joins the Shanghai Cooperation Organization, the population of this alliance will be over half the world's population. It's got a long way to go. It's an industrial revolution. And, nobody can afford to stay out of it. But you know the bad news in this? I think if America suddenly changes her mind and decides she wants to join this bank, I think she'll be refused. And that actually sort of brings us to really what this is all about. And that is the days of the dollar are basically gone. So you were asking me, John, the question about the currency. How do I see the currency? Short term, obviously, we don't know. But what I do see is a whole load of unemployed dollars trying to get back to America. And that's not going to be good. I mean, that is a 1, 2, 3, 4 year story, perhaps. But it's not going to be good for the dollar.
And for our listeners who might not understand the implications of what you just said, Alasdair, put it into layman's term, what happens when all of those dollars come flooding back to the U.S. shores and the U.S. banking system?
Yeah, that's exactly right. And we're already seeing this with the Middle East, because the whole basis of dollars being exported, if you like, as a reserve currency was it transferred wealth into America, dollars outside America, which were then used, if you like, to price everything, particularly energy in the case of the Middle East. Now, the Middle East, Saudi Arabia does not supply any oil, or hardly any oil, to North America. It has no use for petrodollars. Its major customer actually is China. And China is now insisting that, wherever possible, lads, we want to deal in renminbi or the yuan. And the Russians are saying the same about the ruble. And they're trying to internationalize these currencies. And China in particular has done this in London. I mean, I don't know if you're aware of it, but the British government actually issued the first sovereign debt priced in renminbi. This was in the last 2 weeks. And this shows the amount of importance that Britain attaches to London as the center, as the non-Chinese center for developing instruments in renminbi and giving depth to the currency. And China's been running around signing agreements with all sorts of countries. I think the number is up to well over 20 now, whereby the trade will be settled in renminbi, or at least a portion of it. So this is a very big development, and it is very, very bad for the dollar taken over a period of time, because those dollars, I mean, there are an awful lot of dollars floating around outside America, which suddenly have really got no function anymore. And when they have no function, what happens? They go back to America. So you can see that there is all this, all these loose dollars are there to be sold, if you like. They will be sold for foreign currencies and drive the dollar down.
And it's important to stress, too, just as Alasdair had said a moment ago, this is a process that will take a considerable amount of time, a couple of years probably. I don't remember what the exact number of dollars that are floating around internationally for commerce are and for reserve status socked away, but I think it's in the neighborhood of about 10 trillion. And as the petrodollar gets chipped away, with Saudi Arabia selling more exclusively to non-dollar zone countries like China, for example, be more than happy to pay Saudi Arabia in renminbi with their swaps and so forth. And as all these various structures grow in size and in their usage, it will in fact chip away at the market utility of the dollar, because many nations will be using currencies other than the dollar. And what that will do is chip away at confidence in the dollar. And it's kind of like the old saying of you go broke slowly but then very quickly, or something along those lines. And that's kind of like what we're looking at, because the initial stage will be just a reduction of usage, but the speeding up stage can be defined by simply just a confidence matter. And when people reach a certain critical threshold of looking around at the world and saying, gee, dollar usage has dropped by 20% in the last 3 years, we got a big problem here. Maybe I need to diversify very quickly. The train starts moving, momentum builds, and then all of a sudden you can have a currency crisis. And that's when dollars would flow home, and possibly, if the volume is significant enough, shoot domestic inflation much, much higher.
I think there's one thing that I'd like to add to this, and that is the dollar will weaken when people begin to recognize that this is going to happen. In other words, it will be anticipated. It won't. The dollar price won't just adjust as it happens. It will adjust before it happens. So it could be any moment. I mean, to my mind, this week has actually been terribly important. We've got two events. We've got the FOMC, which has effectively turned around and told the world, sorry, we can't raise interest rates ever. We're stuffed. There's nothing we can do. That's the first thing. And the second thing is that America's allies, on a currency basis, are now abandoning America, abandoning the dollar, and moving towards the Asian currencies. And those, I think, are two very, very important developments. I don't think we have seen two important developments in the same week like that for a very, very long time.
Wouldn't you think it's more fair to say a country like the UK is hedging its bets versus abandoning outright? I mean, the bank itself is only capitalized by $50 billion or so now. It'll take some time for it to get some size, and it seems to me that countries like Germany and France, Italy, UK, even Luxembourg's talking about joining the bank. They're kind of like just hedging at this stage. I mean, ultimately what will happen is that just by sheer economic growth, the Asian economic zone is going to end up dominating world commerce, and the dollar's going to fade no matter what, whether it's something as a complete loss of confidence and a capitulation event, or just something that just kind of evolves over time. So I'm kind of curious how you would look at, say, a country like the UK and how they're calculating their geopolitical moves.
The way you have to look at this bank is that, as you rightly say, it's initially going to be capitalized at 50 billion, and the intention is that it'll go to 100 billion. But this bank basically is the lead manager. It will be the lead manager for financing projects. For example, you've got the Silk Road, which itself is about $50 billion estimated. You're going to have all sorts of other infrastructure projects throughout Asia covering half the world's population, in fact, more than half the world's population. Now, this is very, very important. It's not the 50 billion that matters. It's what else is involved on top of that. And the clever thing, as far as the Chinese are concerned, is that they are getting Western capital in to finance these projects through the gateway of this bank. It's not the bank's money that's going to be financing it. The bank money will be in there in syndicates and all the rest of it.
Right.
But basically, it's our money that's going to be doing it. And that's the clever bit. And it's doubly clever because at the same time, China and Russia have effectively defused their enemies. In fact, it is the most extraordinarily, strategically brilliant move I have ever seen. If Putin was a chess player, well, I mean, the Russians and Chinese are famed for their abilities to sort of outwit us, and I think this is an example of it. I mean, it's just, America, all America has been able to do in the face of this new bank is to turn around and say, well, we would rather that they did this thing, put in proper regulations and all the rest of it. And I'm sort of thinking, come on, what planet are you on, for God's sake? I mean, what has actually happened is that America has lost her allies to a commercial venture, which is probably the gateway into the biggest thing over the next 20, 30 years. I mean, we're talking about assembling, if you like, an economic bloc. We're talking about the Shanghai Cooperation Organization, which is the largest economic bloc the world has ever seen. It's actually a repeat of what Genghis Khan put together all those centuries ago, what, 700, 800 years ago. I mean, literally from the Bering Straits to the gates of Jerusalem. That is going to be the Shanghai Cooperation Organization. The members who are about to join are India, Pakistan, Iran, and Mongolia was the last one. Oh, and Afghanistan. And on top of that, you've got Turkey. They're interested in joining. They're a bit further down the road. Now, that's another NATO stalwart. But you can see that Turkey is moving away from the West.
Right.
Turkey has been refused entry into the EC, or EU as it is now, basically because France has got already awash with Muslims and didn't want the Turks to join as well. And so Turkey's given up on trying to join Europe. They're now turning east. They see this huge, great power block. And the Prime Minister of Turkey, Erdogan, is, I think he probably admires Putin because he's behaving in a sort of fairly similar way, being very, very high-handed in terms of domestic democracy and all the rest of it. But you can see that the deal that he's cut with Putin, with the rerouting of the gas pipeline, is absolutely brilliant as far as Turkey is concerned, because they'll take a rake off on anything that goes through. So you can see their interests are moving east. They like gold. And this is the other thing about it. All these countries in the Shanghai Cooperation Organization are accumulating gold. Now, I don't know what role gold is going to play in the new currency paradigm, if you like, the new Asian currency paradigm, but you can bet any money you like that it's going to have a role there to give these currencies credibility. Now, whether there's convertibility or what, obviously we don't know. But these currencies will need credibility if they're going to really kill the dollar. Their credibility has to be greater than the dollar's. And I think that China has already planned as to how this might be done. She's probably in a situation where she's got a number of options and hasn't taken the final decision. But she's been working towards this for the last 40 years. In 1983 was when China set up the regulations which gave the People's Bank of China, the central bank, a complete monopoly over managing gold and silver and the acquisition of those metals. And, of course, that has continued. 1983 to today, that's damn near, that's 30-something years, isn't it? It's, these plans have been going for a very long time, and I'm just surprised that our intelligence services in the West seem to have been caught on the hop when it's been pretty obvious what they've been trying to do. Anyway, there we are.
So recently you wrote about the International Commodity Exchange platform that's going into place tomorrow. And this is going to be very interesting to watch because it'll do away with the London AM and PM fix regime that we've been under for over 100 years. What's your take on how things are evolving as we move 24 hours to the launch of that exchange?
Well, I got an email from the exchange today saying that there are 5 participants. Now, basically, a participant is rather like a sort of market maker. It's not quite a market maker, but rather like a market maker. You have participants and designated clients. If you're a designated client or a participant in the fix, then the orders that you put in are completely anonymous until they're executed. So that's the difference, if you like, between the new system and the old system. In the old system, you had to go through one of the fixing banks, one of the members of the fixing of the fix, and that bank would know exactly what business there was, where it was coming from, what the sort of quality was, and all the rest of it. Invaluable information which helped it, if you like, manage the market and make profits for itself. That has effectively gone. 5 of the 6 banks have been named. We've got Barclays, HSBC, Scotia, Societe Generale, and UBS. That's 5 of the 6 participants. We don't know who the 6th participant is. That they haven't been named as yet. So presumably that will come out later on tonight. The Chinese are not in there. That doesn't necessarily disappoint me because it's not the Chinese style to really go up front in anything. I think in time, once it settles down, one of the state-owned banks may well decide to become a participant. But as it is, they can operate, if you like, as a designated client and buy and sell gold and silver as much as they like. So there isn't really any need for them to become a participant. But I think that they should be able to deal more freely in this market, because it's only after the event that anybody is in the market is going to know who's been buying it and who's been selling it. And I think that's something which the Chinese would be a lot happier with than the previous situation. The other thing that's happening, of course, is that there is a new trading platform being put together, which is due to go live sometime in April. And that, if you like, will be if you like a direct. It will be direct competition to the LBMA itself. It will be in addition to the LBMA, and I think if this platform manages to work things correctly, then it would actually complement the LBMA insofar as LBMA members will be able to deal on this platform, and hedge positions in the London market. In the established London market. So these are very, very big changes. I think that the market is becoming more transparent. I mean, it's quite a liquid market as it is. And I think it's going to mean that it's not who you are in the market, but who's got the deepest pockets. It's the deepest pockets that are going to control the prices, not people in privileged positions. And I think that's as it should be.
Really, it'll be kind of freshening to me anyways to see that be the case, rather than those with the most ones and zeros controlling the market as we're seeing right now over the past recent memory.
Yeah, I mean, the problem we have, I think, is that you've got this sort of Western mentality with virtually everything. It's derivatives, it's stocks, and so on. I mean, the trend is your friend. You stay with the trend. If the trend is up, you just go along with it. You don't actually sort of sit there and think, is this value? No. And, if you talk about value, you just get killed. I mean, I've been talking about value in the precious metals markets for the last 3 years, and look what's happened to the price. It hasn't done any good at all. And I think that the Asian markets take a completely different view. I mean, obviously, we like to buy things that go up, just as they do as well. But they are far more value-oriented. They understand that the reason to have gold and silver is it is, if you like, a hedge out of a monetary system which either you don't particularly understand, or alternatively your experience tells you doesn't hold its value. And in that sense, it really doesn't matter what you pay for gold and silver. The right thing to do is, if you've got some savings, you had a good harvest as a farmer, whatever it might be, you put some of it in gold and silver, and that's going to be far more safe than rupees or ringgits or yuan or whatever your currency is. And it's a completely different mindset from us. And this is really why gold and silver has been disappearing from Western vaults and going into the Far East, and particularly into China.
Speaking of vaults, that's a pretty decent segue for me to ask you a question I've been trying to ask you. About a week and a half ago or so, Andrew Maguire had reported that HSBC was closing their vaults in the London systems, and I believe it was 7 vaults in total. And subsequent to that, you had then stated in an article that you had some information from, I believe it was a commodity broker or a trader, who had informed you that they had received some kind of a notification of that same information. But other than that, I have not been able to find any corroboration of the HSBC story. Do you know more about it now?
Yep, I think I can tell you exactly what's happened. HSBC obviously act as custodians for physical gold for GLD and various other exchange-traded funds. Now, that's one operation. They also, for their private customers in London, offer what they would call sort of safe custody or safekeeping facilities. And it's that they are withdrawing from. And I think to me it makes sense, because any bank like HSBC, which has been offering facilities. I mean, we're not talking about full-scale vaulting facilities. I mean, I think this is, that's not what we're talking. We're not talking about the GLD bars and so on. So we're talking about private customer services, if you like. Private customers in the UK have been selling their gold and silver. On the one hand, you've got excess vaulting space all over the place, which means that the rates are pretty low to vault things, and they've lost volume. So this is something which I think they see as not really earning them anything. It's a pain in the backside. It's too small. It's far better to close it, and then that's a whole amount of paperwork they don't have to get involved with. And I think that's really what's driven it. Of course, they handled the announcement very badly, because the first thing that happened is that dealers in gold and silver were getting notices saying, take your stuff out within the next 60 days. We're closing it. So, right. There was no announcement. Indeed, at Gold Money, we had some of our customers who have also HSBC clients. They came on to us and said, have you heard about this? So anyway, I dug down into it to try and find out what it was, and that's what I came up with, and I'm pretty satisfied that that's the answer. I don't think there's anything sinister in it. I think it's just a very badly handled press release in a market where we're really all jumpy, and a lot of us jump to sort of conclusions before we have the evidence. It's the nature of gold and silver at the moment, and I think that it could have been handled a lot more sensitively by HSBC.
So, out of curiosity, have you seen or heard of anything that differentiates between clients that are storing allocated gold or paper products when it comes to HSBC? I mean, are they closing the vaults and sending notices to all of their customers that they're exiting the private client gold relationship status in general, or are they putting emphasis on allocated storage customers? I mean, is there kind of an echo here with respect to ABM Ambrose, what some people consider to be an outright default, but having difficulty in proving all of that? But all of that being said, I do wonder if there is a little bit more here to the story than meets the eye.
My understanding is that it only really applies to HSBC customers who are using HSBC to store their own gold and silver. I mean, it's almost like sort of safe deposit box type facility, if you like. The allocated and unallocated accounts are really a wholesale market thing, and that's more to do with the LBMA, and that's not what we're talking about. The very fact that HSBC is a participant in the new fixing arrangement tells me that, yes, they continue to be committed to the market. And the other thing, of course, is we don't forget that their origins are Hong Kong. It's the Hong Kong Shanghai Banking Corporation. Their contacts into China are second to none. And China is a very, very big buyer of gold, as we've known for a long time, a lot more than the World Gold Council will admit. HSBC, I would be very surprised if HSBC decided that this was something that they didn't understand and, weren't going to put much effort into. I mean, they are very much involved with it. They're members of the international Shanghai, the offshore Shanghai market there. I think their direct members also of the Shanghai Gold Exchange. They do see this as a major activity. It's just they're withdrawing from unprofitable client business, the sort of thing that banks do all the time. But it just got sort of rather confused, if you like. The message got rather confused because they didn't actually produce a proper message about it.
Any other thoughts regarding what it sounds like is a historic week in the currency markets?
Well, there is one thing we haven't touched on at all. I don't want to take everybody's time up too much. I'll just mention it in one word: Greece. I'll mention another word: collapse. I'll mention another phrase: end of the euro ? I mean, it is a complete mess. There was a meeting today. I think it's probably going on as we speak between the finance ministers in the eurozone. and they're trying to resolve this, and there is no resolution. Greece is bust. Yanis Varoufakis was quite open about it. He said, look, we're bust. And the problem is, and he knows it, and everybody else now knows it, the only reason that Greece is sort of paying all this sort of money under austerity and all the rest of it is so that the banks don't take a knock. It's all an operation to support the banks, and the Greeks are fed up with it. So, it's hardly surprising that this is now creating huge, huge difficulties. And I think whichever way, it's calling into question the whole validity of the concept behind the euro. I don't think Greece necessarily leaves the Eurozone. In fact, under the Lisbon Treaty, you have to have unanimous agreement before anyone can consider leaving. Now, by unanimous, that also means that Greece has got to agree. So what if Greece doesn't agree? Greece isn't going to agree to be kicked out of the Eurozone. I mean, it doesn't make any sense for them whatsoever. So,
unless they get an amazing deal with China and Russia.
Well,
that is a possibility.
Well, no, that doesn't change anything because, you've got to think, what currency do people in Greece use? They use the euro. That's not going to change.
In the context of going back to the drachma is what I meant.
Well, I don't think. No, you see, I don't see it. I mean, Yanis Varoufakis knows this. I've been sort of involved, sort of third hand in some email correspondence with him, and he's a shrewd individual. He's a professor of economics who, basically sees the issues. I think the way the three of us see them, and that is they're being ripped off to keep the banks going. Now, on that basis, that really. He's turned around and told the other finance ministers, sorry, we're not playing that game anymore. Deal with it. Now, when it comes to the currency, everybody in Greece uses the euro, so there is no point of coming out of the Eurozone as such. Anyway, under the Lisbon Treaty, they can't be kicked out. And nor, for that matter, can Germany leave. Okay, they can break the treaty, but that's not what we're talking about. We're talking about people going with agreement, if you like. If I was Germany, I would probably be considering my position and thinking, well, I'm going to break this agreement. I think that's more likely than Greece going out of the, setting up a drachma. Because what's going to happen to the drachma? The drachma is just going to collapse, isn't it? I mean, it's nowhere. If, on the other hand, they can do a deal with Russia, which I think is quite possible, I think the deal would be a commercial deal because with Putin, he's looking for a commercial advantage, and I think it's probably got something to do with pipelines, gas, oil, energy supplies, and all the rest of it. And on that basis, he might help Greece over a little local difficulty. But you see, again, he's got the problem that, okay, if you give Greece $1 billion today, are you ever going to get it back? So no, the only basis in which this is going to work is he's going to want guarantees, if you like, of business, which is going to more than compensate for whatever he gives them in the short term.
Well, yeah, I think that'll be a factor. But if you look at the history of Russia's policies towards Ukraine, they were very forgiving and willing to see a few billion here and there go up in smoke just to try to get some geopolitical gains, and the ability to peel away Turkey 100% from NATO with link up with, God forbid they were able to get the Greeks and the Turks together at the same table, but, extending of pipelines and so forth. Yeah. I mean, that could conceivably be quite a coup for Russia geopolitically, by which they'd be willing to throw some billions around and just see where the chips fall as they may, so to speak.
Well, the other thing that might get a bit of money going Greece's way is naval facilities.
Yeah.
Docking facilities in the Mediterranean. I think the Russians would love to have an alternative to Syria.
Yeah, well, they just redid their agreement with Cyprus, so they are inching in that direction.
That's true. Yes, that's true. That's true. You see that, and they were doing it with the Greek part of Cyprus. So no, I mean, there are deals to be done there, but I don't think it involves leaving the Eurozone. I really don't.
Well, I think that's a good place to wrap up the show this week. Alasdair, as always, it's a pleasure having you on.
It's very much my pleasure. Thank you for having me on.
Before we let you go, if you could let the listeners know where they can find your excellent regular reports.
Well, I'm head of research for Gold Money, so if you go to goldmoney.com, you'll find me there under research. And also I've got my own website, which is financeandeconomics.org, O-R-G.
All right, that'll be a wrap for this week's show. For the Doc and Eric Dubin and Alasdair Macleod, thanks for tuning in to this week's SD Weekly Metals and Markets.